What is an interest rate? Actually, interest rates are quite unique in terms of finance and in terms of the economy. What an interest rate is the way that people will trade money today versus tomorrow. It has to do with investors' preferences for the timing of their actual money. So obviously, I would prefer to have $100 today to having $100 next year. Everybody would choose $100 today versus next year. If I am told that I cannot have the $100 today, that I'll have to wait till next year, then what I'll want is a little extra return. Because if I had the $100 today, I could invest it and earn interest. So the interest rate is the way that the money is basically traded off between different horizons. It's the rate of trade-off, and it has to do with investors' preferences. Now, most of us know what some simple interest rates are. In the lecture note, which is assigned for pre-class and the associated assignment that's available for you, we go through some of the basic definitions of interest rates. Some simple ones that you're probably familiar with are rates like the annual percentage rate or the APR rate. And often we're familiar with those off of our credit card rates. A standard credit card rate is 18% APR. And what does that mean? Well, it means that the interest rate you're charged if you carry a balance on your credit card is 1.5% per month. So the way to get the so-called effective periodic interest rate is to take the annual percentage rate, which is 18%, and divide it by 12, the number of months in the year. 18 divided by 12 is 1.5%. So if I carry, let's say, a balance of $100, and I don't pay that $100 on my credit card for a full year, each month I'm assessed 1.5% of my outstanding balance. So after the first month, I'm going to owe $101.50. And then 1.5% is going to be charged the next month on the $101.50. And this is going to continue to the end of the year. And the end of the year, what I'm going to owe is not $118. So don't be confused by the annual percentage rate. It's just like an annualized rate. It doesn't really have that much meaning in terms of investment purposes. So 18% of $100 is $18, and I don't owe $118. It turns out that I owe more. I owe $119.60. So the annual percentage rate is not a true investment rate. It's just a quoted annual rate. The true or the effective interest rate is quoted monthly, and it's 1.5% in this case. And if I wanted to annualize that rate in terms of a compounded interest rate or a true interest rate for the year, it turns out that this is 19.6%. And the way that I would do that, and it's detailed in the lecture note, is to take 1.015 and raise that to the power of 12 and subtract 1. This is the way to get a true or annual interest rate from a monthly interest rate. So fundamentally, these interest rates tell us something about the way that we trade off money this year or next year. A bond has an interest rate, and often these bonds are paid semi-annually, so the interest rate on the bond might be 8%, 8% coupon rate, and that means on a $100 bond you get $4 every 6 months. So that's called the coupon rate on a bond. Now the interest rate, I said, tells us something about the way that we're trading off money from today to tomorrow. And it turns out, of course, that the interest rate changes through time. And we've seen fairly large fluctuations in interest rates. As I detailed in the historical behavior of asset returns, the interest rates on the simplest instrument, which is the United States Treasury bill, have varied from 0.1% in the 1930s to 17% in 1980. So interest rates can vary. And the reasons that interest rates vary really take us to the heart of what is the economic meaning of an interest rate. So I said already that it's by definition the way that we trade money this year to next year. But what determines the rate that we choose? What determines this preference for trading money this year to next year? Well, there's a number of factors that go into it, but there's mainly two factors. The first is what we expect in terms of economic activity. And let me be a little more specific on this. That suppose that we expected next year that there was going to be a fairly severe recession. And this would mean that my income would be reduced, I'd have a lower bonus perhaps, that my standard of living could be at risk in a recession. I might be laid off my job. I might be reorganized. There might be a merger. And generally, consumers prefer to have a smooth standard of living. And if there's changes in your standard of living, you actually prefer them to go up rather than down. So this smoothing is the motive for insurance, for so-called hedging. So if this bad state occurs with a recession, a severe recession next year, what I'd like to do is to have some other investment pay me off. So this would be like insurance. Insurance always pays you off in the bad state. And it is the essence of hedging. So what's going to happen is that if we're in a plentiful state of the economy right now, that investors might decide to take their money, invest in longer-term instruments, and my example would be like 1-year investments. They might be certificates of deposit, they might be very short-term bonds or treasury bills. But investors would shift their money to hedge for sort of recessionary times. Now, this shifting of the money to the 1-year treasury bill, let's say, for example, what is it going to do? Now here, you already know from your economics courses the basics of supply and demand. As more people try to buy the 1-year treasuries, the price goes up. As the price goes up, in terms of a bond, the interest rate always goes down. Okay, now let me explain that a little bit because it has to do with the basics of interest rates and the basics of bond valuation. And we'll go into much more detail about this later on in Lecture 1. But a treasury bill is kind of a unique instrument in that it doesn't explicitly have a coupon. The treasury bill promises to pay $100. In our example, it's going to be $100 in 1 year from now. Now, obviously, nobody buys that for $100. So if you purchase this 1-year Treasury bill at, let's say, $90 today, next year you know that you're going to get $100. The rate of return is $10, and a $10 rate of return on a $90 investment works out to about 11% interest. Okay, so the rate of return is about 11%. Now suppose that people start to purchase these 1-year Treasury bills because they expect a recession next year. Well, as soon as they do that, it's going to increase the price. So when you go from 90, let's say, to $91 or to $95, it's going to reduce the rate of return that people are going to get on the Treasury bill. So if we have to buy at $95, a year from now we get $100, and we get $5 in terms of the payoff. We invest at 95, we get 100. So the rate of return is 5 divided by 95, okay, which is much smaller than 11%. So as people are trying to shift their money to hedge for what they expect to happen in the economy, we're going to see fluctuations in interest rates that are fundamentally linked to the state of the economy. Now that's one thing, and that's very important for determining interest rates. And there's clear, unambiguous patterns in interest rates and the business cycle. And this actually, I would refer you to, for example, my 1988 Journal of Financial Economics paper called The Real Term Structure and Consumption Growth, or my 1991 Journal of Fixed Income piece called The Term Structure and World Economic Growth. In both of these articles, I trace the relation between interest rates and the business cycle. And I do this for 7 different countries, the G7 countries. And I find that there's an unambiguous pattern in interest rates and what happens in the economy. And interest rates are forward-looking. That we're doing things today in terms of shifting our money. The people are buying the 1-year Treasury bill today. They're buying it today because of what they expect next year. So we can see things in interest rates today that help us distinguish what's going to happen in the future in terms of the economy. So interest rates contain expectations of economic growth. Now what else? The other obvious thing that interest rates contain are expectations of inflation. So if you expect that there's going to be 10% inflation over the next year, then there's no way that you're going to purchase a Treasury bill for $95. You purchase the Treasury bill for $95, you get a rate of return that's a little over 5%, 5.5%. But inflation is going to eat 10% of your investment. So the overall rate of return would be negative. They'd be throwing money away by investing in the Treasury bill. So if people expect a 10% inflation rate, then you can be sure that the Treasury bill rate is going to be lower, that the price of the Treasury bill will be less than $91. This will ensure that investors are compensated for inflation and make a little extra return. Now, sometimes people call this the real interest rate. So the interest rate that I quoted you, for example, with the Treasury bill of a price of 90 that has 1 year to maturity, that interest rate is 11.1%. And that's a so-called nominal interest rate. And when we say nominal, it means that it includes inflation within it. And often what we do is we consider real interest rates. So the real interest rate would be the rate after you subtract out inflation. So over the year, if 10% inflation is realized, I made an 11.1% return, a nominal return on the Treasury bill, but inflation was 10%. So the real return that I actually made was only about 1.1%. So the real interest rate in this case that was realized over the investment horizon was about 1.1%. So often people talk of real interest rates, people talk about nominal interest rates. So these are two fundamental building blocks of interest rates. The expectations of economic growth and the expectations of inflation. Now, it turns out that there's a third thing that I don't go into great detail about, but it is actually important in the elective courses in global financial management, asset allocation. And this has to do with the correlation between expected future economic growth and inflation. So there's what's expected in terms of the economic growth. There's what's expected in terms of inflation. And there's also an expected correlation between economic growth and inflation. And we'll see when we do portfolio analysis that this correlation is very important. And this correlation could potentially, if it's negative, cancel out the two effects, or at least diminish them. So there's three fundamental building blocks that go into interest rates. The expected economic growth, the expected inflation, and the correlation between growth and inflation. And this pretty well defines the interest rate. Now, there's one other very important thing that I haven't mentioned that also is a determinant of interest rates. And that has to do with the investor herself. Now, I told you that there might be a motive for certain investors trying to hedge their standard of living. So they'd be able to give up some of their wealth today to ensure that next year they're protected, let's say, from this expected recession. So they wouldn't have to go and reduce their standard of living dramatically. It turns out that it's really important what the degree of risk aversion is in the economy. Because if investors are very risk averse, they definitely do not want to reduce significantly their standard of living in recession. So risk averse investors, very risk averse investors, will really try to smooth their income. In doing this, what they do is to drive the price of that treasury bill even higher. And it kind of makes sense. If people are not risk averse, if they're so-called risk neutral, then they don't care. That recession next year, no big deal. It means I have lower income, and I'm willing to live with that if I can live. That's what a risk neutral person would do. So there's no extra demand for the 1-year treasury bill. And the price will not change. So we're not going to see fluctuations in interest rates that are related to expected economic growth. But the more risk averse the investors are, the greater the motive for hedging, the greater the motive to ensure that there are not significant fluctuations in the standard of living. The greater the action will be to create the type of investment portfolio, usually using bonds, that will ensure minimal volatility in the standard of living, minimal fluctuation. Now, why use bonds for this, or why use treasury bills? They're the simplest way to do this. One thing about a treasury bill is a remarkably simple instrument that is guaranteed by the government. You buy it today, you get $100 next year. Simple. You cannot say that for a corporate bond. You can definitely not say that for an equity investment. An equity investment, who knows what you're going to get next year? The value of the investment could be zero, or it could be multiplied by a significant factor. But a bond, you know what you're going to get. It's less risky. As a result of that, the expected rate of return on the bond is less. But this is really a unique instrument, as I said, and part of the reason it's unique and part of the reason that it's forward-looking is that it is so simple, that it is the price of $100 1 year from now. So it's very useful to look at these simple bonds and go through these examples, because it is the essence of what an interest rate is. So the economic meaning of an interest rate is important to understand before we actually go through and do all of the mechanics. The mechanics are sometimes overshadowing of what the true meaning of what we're actually trying to do. So in this course in particular, I prefer an understanding of the economic intuition behind every instrument that we examine. This is not the sort of course where you are presented with formulas and told to solve for this and solve for that without really thinking about what you're doing. This is the type of course that you need to understand the fundamental economic foundations of each of the instruments. And only after you understand that should you be going and doing the mechanics of the valuation. It turns out the lecture note goes through a lot of mechanics, but do not lose sight of the economic meaning of what an interest rate is.